Good evening to all of you in India, and good morning and good afternoon to everyone joining from other parts of the world. My name is Kushu Pantaki, and I welcome you all to this particular webinar hosted by Thornton Bharat on decoding the global banking crisis, or what we say, the global banking stress. We have a very distinguished set of panelists today for this particular webinar. We have Matt Cullen, who is the global banking industry leader for Grant Thornton. Matt is based out of New York, United States, and has a significant experience on both the sides, on the professional firm and the professional experience side, and on the banking industry side as well, an experience of about 30 plus years. Thank you, Matt, for being there today on this particular panel. We also have with us Paul Parambi. Paul is the Chief Risk Officer at Kotak Mahindra Bank. He has been with the Kotak Group for the last 30 years and currently looks after all the risk matters in relation to the bank and the group. Thank you, Paul, for being there this evening for the panel. And we also have Vivek Iyer, partner on financial services risk advisory and leading the financial services risk advisory for Grant Thornton Bharat. Vivek is someone with about 25 years of experience advising global and Indian banking clients on risk advisory matters. Friends, our topic today is, of course, decoding the global banking crisis. We have heard a lot in the last couple of years about what's happening globally on the banking, especially in the last 2 years. These have been characterized by a lot of uncertainties, starting with the pandemic and followed by the galloping return of inflation, the war, the rising interest rates, and the disruption in the supply chain. Globally, volatility was somewhat unprecedented in markets, ranging from stocks and bonds to the cryptos and the real estate. For the banks globally, this really meant the end of a relatively stable decade as a result of shocks to the system on account of the geopolitical instability coupled with disruptive effects from the pandemic. Severe stress in the global financial system has become very apparent in the last few months. In the United States, the Silicon Valley Bank's collapse was the first domino to fall, which was followed by the New York Signature Bank. The Wall Street's biggest lenders also came together to rescue the First Republic Bank after its shares crashed, and they pumped in about $30 billion into it. In Europe, the Swiss National Bank was forced to offer a lifeline of about 44.5 billion pounds to Credit Suisse, followed by UBS agreeing to buy it in an emergency rescue deal aimed at curbing the panic in the financial services markets. However, amidst all these challenges, there are some bright spots, some healthy spots, with outperformance to be found in India and the other growing markets. The country's largest banks in India, they really stand out, not only within the country, but also globally for their consistent performance. They trade almost at a premium, which is between 2 and 2.5 times than the book value. As these leading banks continue to focus on scaling their businesses, they are attempting to put in place prudent risk management systems. In addition, they are applying state-of-the-art analytical capabilities to constantly improve their decision-making and their risk management framework and architecture. Their investment in technology and innovation, especially those aimed at building a completely digital ecosystem to enhance the customer experience, has truly helped them to achieve this performance and can serve as a lesson to many other banks globally. The biggest learning, which probably arises from this, is that at a time of global volatility, the banks globally need to focus on endurance and sustainability, improving their short-term resilience and embracing longer-term opportunities to grow and become more profitable. So with this particular backdrop and the perspective that I have shared, maybe let me begin the panel by the very first question to Matt. Matt, my question to you would be that what would you attribute the current challenges faced within the US banking system to? Would it be only inflation, or do you think that there are some other factors at play as well?
Great. Hey, nice to be here. Thank you for the invite to join you. You know, it's interesting, like every crisis of the past, I think really it starts with a confluence of events. And I think we can trace the origin of this particular crisis, obviously back to COVID and the restrictions that were placed on businesses, cross-border commerce, interest rates, some defaults in the mortgage sector and so forth. That started the ball rolling. But I think really what's interesting about this particular crisis we're going through is it's the confluence of different types of banks, right? You know, you can generally trace this back to weaknesses brought to the forefront around an increasing interest rate environment, right? So the central banks have started to raise, at least in the US, have started to raise drastically the interest rates to combat inflation. And the traditional bank models of, let's call them the large banks, like an SVB or a Signature, you know, a lot of this resulted in a negative carry situation, which historically some of the banks were okay with. The negative carry is basically when you have invested assets that are at a certain fixed interest rate for very low, and then you have to fund them with floating rate assets where the interest rates are going up, producing this kind of mark-to-market, theoretically mark-to-market adverse event, but also a negative carry in your P&L. And banks historically, some of them have been very good at hedging these risks. Some of them have said, this is the business we're in, and we're okay not doing that. But I think what we're finding out is that's not okay, you know, for a lot of these banks. When you look at kind of the global banks, I think, again, you can go back to the weaknesses brought about for the forefront of the rapidly rising rates, but I think what we're seeing there is more of a governance issues, right? Governance issues and investors that are becoming more, let's say, astute in where they want to put their investments in the global banking sector. And so, you know, the cause of, when you look at this, you know, so in the US, I would say, first and foremost, it's about concentrations in the tech industry or the crypto industry, right? Deposits, the fleet of deposits, and the fact that we're still dealing with an FDIC or regulator that ensures only certain limits. And so when, you know, there's a panic that occurs naturally when banks start being called into question, right? And so that's really what was the progenitor for this in the US banks. But largely speaking, it's the interest rate environment that we're going to deal with here.
Thank you, Matt. Thank you for that perspective. And Vivek, just a little extension of what Matt mentioned right now. Maybe you could just spend a minute or so in terms of exactly what happened at the Silicon Valley Bank, so that, you know, the learnings from there could be really some lessons for the global banking world and even some of the other places as well.
So thank you so much, Kushu, for having me as a part of this esteemed panel. Incidentally, in terms of, to simplistically put in terms of what happened at Silicon Valley Bank, was essentially in terms of from a liability perspective, in terms of a lot of deposits were concentrated with a certain set of players. So largely the technology players. And as the funding winter kind of was approaching, given the whole expected slowdown globally because of supply chain issues and because of the Ukraine crisis, as a result of that, a lot of these technology companies actually started withdrawing funds as the interest rates increased, in terms of as the pressure on the liability side increased to kind of by the depositors to withdraw funds. At the same point in time, the asset side was also kind of experiencing losses on account of the interest rate hikes, and people had to actually, in terms of, sell some amount of the assets for the purpose of funding the liabilities. Now, the key issue technically in terms of happened is that ideally when it happens, there is a pressure on your capital, because just imagine in terms of your liability, in terms of the pressure to pay it off, and your assets are winding down. And if your assets are at a loss, then there is a pressure on capital. And to maintain, and when there was actually a decision by SVB to actually raise more funds, what was the fear actually in terms of manifested itself in the form of a panic, where they actually said that, oh, there seems to be a stress, let's withdraw the funds faster. So it kind of was a self-fulfilling prophecy that kind of, that's how usually in terms of panics happen. And that essentially in terms of what accelerated the crisis and significantly in terms of caused the issue. The root cause was more in terms of a significant concentration of the deposits within a certain industry. So it was essentially in terms of the way the liability profile of the banks were. I don't blame them, because a regional bank is not expected to have a diversification as equivalent to a large bank, which is essentially what Matt was alluding to when he actually started off to say that, these are the non-large banks and there are certain business realities within which they operate. So it was unfortunate in terms of as the interest rates were being increased by the Fed, there was this consistent worry in terms of, from a financial stability standpoint, how exactly is it going to sit in the ecosystem. And the smaller banks weren't really subject to the stress tests on account of exemptions in the past that were actually provided to them. And as a result of that, when the stress was building in, the ability to kind of look at something that was happening was impossible. So honestly, in terms of two pieces, deposit concentration and regulatory oversight in terms of from a stress test point, were the two pieces really in terms of why this seems to have occurred.
No, absolutely. I think you're right. The entire vicious circle of concentration of deposits, the panic, the withdrawal of deposits, the interest rate increases, the funds not being deployed properly, and of course, the losses caused on account of mark-to-market fluctuations clearly sort of led to the collapse.
And this is really really ALM 101 kind of a situation, because if you have short-term liabilities, you shouldn't be placing the funds, you're deploying it in really long-term assets. So that's a recipe for disaster in two situations. One, if interest rates go up, you're then sitting on a loss because your durations are different. Or two, you see your liabilities flowing out. So I would say SVB is a classic case study for that.
Absolutely. Thank you, Paul, for that perspective. And my next question to you, Paul.
Yeah.
Do you think that during an unprecedented high interest rate environment, as is prevalent today, which is what we have been seeing, a rollout of a special regulatory stress testing framework would have been really helpful? We understand, of course, that there is no right or wrong answer here, but some thoughts on this would really help our participants to understand a little better.
Sure. See, stress test, a special regulatory stress tests, given the crisis, could certainly help. But I think the issue goes deeper. If you look at the situation which we are seeing here, you really have a situation where the smaller banks are not subject to the same kind of regulatory requirements as the larger banks, whether it's capital requirements, whether it's asset liability requirements, and so on. The second, of course, is the regulatory oversight of all these banks. Now, this to me is a recipe for disaster, and that's where really the learnings come into play, because if interest rates go up, then clearly the investment portfolios of lenders who've actually taken, who've therefore deployed their funds in the long term are going to take a beating. And at this point of time, the mark-to-market hit on the entire US banking system because of interest rates rising is close to 1/3 of the capital of the entire banking system. Now, just to put a comparison of that to some of the largest banks in India, when we did a rough analysis, and we don't have full data for all those banks, the regulators would have it. I would say for the largest banks in India, this would be sub 5%. Okay. And for many of us, it would be in very, very low single digits. So when you talk about 33% of the entire banking system equity being at risk, that is a serious risk. The second is when interest rates go up, the real economy can face stress. And therefore, if the smaller banks, and 80% of loans, for instance, in the US to commercial property is given by all the smaller banks. When interest rates go up, this is a sector which can clearly face stress. So if there isn't enough regulatory oversight, it really puts the entire sector at risk. So to me, I think the learning really is, yes, stress testing needs to be done, but the regulatory oversight needs to be much broader.
Matt, maybe if you would like to sort of, share your perspective. I'm sure in the US, there is a very strict regulatory oversight. Anything that you believe could be strengthened further to ensure that such things don't happen again?
Well, yeah, I mean, one discussion that's taken place, often is let's call them, we might call it the antiquated FDIC rules. Like what is the insurance that covers these deposits, the limits that are set? I think we all know that in the event of these, and we see it again and again, in the event of these types of bank failures, the US government tends to come in and insure deposits regardless, right? So is the $250,000 limit that's been placed, is that realistic? I think most people will say no, that's probably a limit that's from the 60s, something very antiquated. And so, potentially increasing the limits to allow for greater coverage of the losses, but also, potentially some say just let's put no limits, but put a limit on the now that's where you flip to the bank. The bank should potentially have limits as well on deposits, and they have to come up with their own customized or tailored limits for this. And again, that's really based on stress testing, or it could be something that's some percentage of capital, however you want to come up with that. So I think those are the big things that when it comes to the deposit side of the equation, I think most people are talking about how that could fix some of what's
absolutely. And that's becoming a much more expensive proposition for the banks. Especially I can talk about the banks in India, that the premium that one would pay for these kinds of insurance coverage, that particular cost is sometimes much higher than the cost of technology that the bank deploys to carry out its business. So definitely from a cost standpoint also, it's a matter of concern. But over a period of time, I'm sure that this is going to be the main agenda driving the regulators to strengthen the deposit framework along with the insurance. So thank you for that.
Matt, just for your information, in India, the equivalent of $250,000 is about $6,000. So here 250 sounds reasonable.
I just think it's very difficult to avoid the moral hazard that the federal government has, right? So why not embrace it and institutionalize it and manage it from there? So
yeah. Just let me put this question, and maybe I would request like a 1-minute perspective from all of you. A lot of people, and I'm sure your friends and colleagues, etc., would have also sort of spoken about the crisis currently being compared to the most disastrous crisis of 2008, which happened globally, which we are all are aware of. So do you believe that there are any similarities between 2008 and what happened in 2022 or 23? And is this something really serious? Matt, your perspective?
Well, I lived. So first of all, I think the 2008 crisis was fundamentally a credit crisis, right? There were actually losses being incurred following, subprime lending in the US, which became pervasive and, quite frankly, enormous. This is a different crisis. I think it's I think what it's doing is it's uncovering, and like, I think where the similarities really come out is that you'll see a confluence of events. I mentioned this in the beginning. We always see these confluence of events that occur that nobody anticipates. It's hard to anticipate events like this. So I think where the similarities start is on the confluence events, but I think fundamentally it's a different type of crisis than the 2008.
Thank you. Paul, your perspective?
I agree with Matt. The situation is different. The root cause of this is different. And each crisis to that extent is, so that one was essentially, as Matt said, subprime lending, mortgage-backed security kind of a crisis. This is a crisis which is, as we've already discussed the reasons for this one.
That's right. Vivek, anything further to add?
No, but yeah, I agree with both Matt as well as Paul that this crisis is substantially different from the 2008 crisis. I mean, this crisis technically in terms of really started from the liability side of the balance sheet. That was more an issue on the asset side of the balance sheet on account of the whole credit crisis and the underlying asset issues in terms of fundamentally that which was the challenge there. Also, in terms of back then, it was about a lot of the crisis we see today is on account of challenges on the liability side and a lot of restrictions in terms of what banks can do. Back in 2008, the kind of activities that potentially banks could do was significant. So inherently, there was excessive risk taking that existed, which led to the crisis. This was more in terms of a situation where a lot of external factors kind of came together and really caused in terms of in terms of the challenges. Yes, to some extent, the bank strategy also kind of plays a certain amount of role there, but very different.
Thank you, Vivek. I completely agree. I think, yes, there were different reasons for the two different collapses. And that's very clearly being sort of, differentiated in the responses from each one of you. Paul, let me come to you now. I think this is again to do with the global crisis. We've seen the Credit Suisse situation, which talks about the global stakes existing. But of course, there are certain banks across the globe which are really outperforming. For example, many regional banks in the United States and the top 5 banks in Canada, for example, they are really performing very well. There are many emerging economies such as India, Indonesia, Mexico, South Africa, where the largest banks by market capitalizations are really performing very well. What do you think some of these banks have been doing better off in some of these developing economies or emerging economies compared to the Western world, which are much more developed economies?
Yeah. So, as one looks at what's happened to Credit Suisse or an SVB, etc., though Credit Suisse, of course, is a globally, systemically important bank, I think the circumstances of those banks and the reasons which you've mentioned are slightly different. The interest rates in many of the developed economies were close to zero or close to zero, and as a bank, that puts an enormous amount of stress in terms of spreads and how you actually run a profitable business. As we went into COVID, at the bottom, the interest rates in India, as you're aware, the repo rates, that's the RBI's rate at which it would lend to banks, was 4%, right? Or borrow from banks was 4%. Now, at that kind of a rate, if you have surplus as a bank, you can deploy it maintaining short durations. If you're at 0%, and the only way you can generate any return is by going 10-year down the line, to a 10-year duration, you're forced to, you can be forced into wrong kind of behavior, right? So therefore, the guardrails have to be extremely strong. So interest rates were much higher in many of these economies. Some of the developed the economies, including the US, the interest rates were close to zero. The second is, if I were to look at a Credit Suisse and the regional banks or the large banks in most of these countries, the business model of a Credit Suisse and the kind of things globally systemically important bank, the kind of things it could do or would do are of a different order of complexity, right? And therefore, it brings in a different level of risk and a different level of requirement of risk management. So the circumstances in these two ways were different. Having said that, I think what one has seen is, one, of course, the banking system had become a lot stronger. Definitely, if I were to look at India, the banking system had become a lot stronger after the crisis we saw about a decade ago. After that, the bank's balance sheets have become a lot stronger. But what was also there was very tight guardrails around the entire banking system. The requirements of banks were reasonably uniformly laid out irrespective of size. There could be some additional requirements for the biggest banks. For instance, a bank in India cannot have more than 23% of its investments kept as held to maturity. That is where you don't mark to market and show the losses on a quarter-on-quarter basis, right? Therefore, you can't actually have a big asset liability mismatch which you build up on your investment book this way, because you'll start showing losses immediately, right? Or the governance structures required, the asset liability requirements, and so on and so forth. So some of this regulatory oversight actually played a big role. I would say for me, the learnings which would be there are, I think the regulatory requirements of all institutions, including the smaller ones, need to be fairly tight, particularly banking institutions, which are some of the most fragile institutions, because lack of confidence means the bank can shut overnight. The intensity of oversight can vary, but the boundaries need to clearly be there. And the second is, what this teaches us is, as a bank, you need to have very robust risk management. If you don't have it, then you're playing with disaster. So if somebody is sitting on the board of a bank really needs to be, or the regulators overseeing banks really need to be looking at the quality of risk management in there, and they need to come down very harshly if that's not in place. So that's what my inputs would be.
Thank you, Paul. Matt, anything from your side, just to add or supplement?
No, I think everything is spot on what Paul is saying. I think the question that comes up that nobody wants to talk about is, obviously the larger banks are doing well because they have deep diversity in their books, right? And we all know that the large banks are absolutely critical to every economy that's out there. So the question is, what do you do with the smaller banks, right? The regional banks, how to regulate that, how to manage that. And I think that's the big challenge. I think this is the challenge that this is bringing up right now is, do banks need to be a certain size to be able to conduct business, right? In a proper risk environment. So that's a question. I'm not sure I can answer that right now.
No, that's fine. That's fine. Vivek, maybe on this particular question, you can talk a little bit about how the Reserve Bank of India within India is actually now putting everybody on the same platform and ensuring that over the next 2-3 years, they all are going to have the same rigor of inspection and supervision. It could be NBFCs, it could be small finance banks. So maybe a couple of minutes on that.
Yeah. So the regulator, in terms of at least the Reserve Bank of India, one of the biggest thought processes and concerns that they actually have is the more focus in terms of how exactly the interconnectedness within the system. What kind of challenges can essentially, from a financial stability standpoint, come out of that? That is one of their key concerns significantly in terms of what they are focusing on, which is in terms of seeing, are there any white spaces in terms of between the different types of regulated entities that could potentially result into a challenge. And increasingly, whatever is the regulatory arbitrage that kind of exists between banks and NBFCs, they're kind of trying to do away with it. Obviously, in terms of one is, the three pieces, in terms of, the regulators in terms of focusing on essentially in terms of inflation management, financial stability, and, in terms of supervision, essentially supervision driving financial stability and regulation. And from that perspective, at least from a Reserve Bank of India standpoint, there is an increased focus on supervisory oversight. And that comes in terms of a change in the way, in terms of the risk-based supervision framework kind of works with respect to banks, NBFCs, including urban cooperative banks. One of the points I would definitely, in terms of, like to put on the table is that, as the market changes, and evolves. There are new forms of risks that kind of come in, and the regulator, in terms of from his supervisory oversight standpoint, kind of significantly sees and evaluates in terms of how the changes have happened. We have had issues from a banking system in the past, asset quality issues in terms of a very similar cooperative bank issue, a very similar challenge from from a bank bailout standpoint in the past. From an Indian standpoint, we have had our fair share of learnings as well. And that is something that the regulator has factored into account and is driving. We see something happening globally as well, driven by confluence of factors. And essentially, in terms of that's also where the regulators are kind of focusing on and looking at. The only thing, in terms of where I would see is that there is a lot of focus that the regulator is going to drive from a supervisory standpoint. And any amount of changes that they are expected would, the direct outcome would be in terms of how adequately capitalized are you. That's essentially the direction in which they would actually in terms of go. And there's a lot more focus on governance with the whole announcement of, in terms of yesterday, in terms of the focus on governance and culture, increased oversight that RBI basically in terms of is contemplating. Those are some of the bigger changes because governance is a forward-looking indicator for the regulator. And that's going to be the significant anchor for them to monitor the banking system in terms of going forward. I wouldn't say that one is better than the other. And, in terms of, as a regulator, we have done so much and others have not done so much. That's not a fair assessment. But I would say that it's evolving. And I would say that the regulator from an Indian standpoint is also kind of significantly pushing the envelope in that direction.
Oh, that's great, actually, and I completely agree with you. I think a lot of responsibilities on the board, on the independent directors, on the CROs, on the risk management framework, and ultimately, I think the fair practices, as all of you rightly mentioned. Let me shift gears now, since you spoke about governance, and I think that one particular term that comes into my mind is the ESG. And I think some people would think that what has ESG got to do with an organization or a bank, which is in the financial services industry? But ESG plays a very, very important role. So my question to Matt is that, what kind of significance or momentum ESG has gained globally insofar as the banking industry is concerned? How serious are these banks in terms of the integrated reporting, including the reporting on the ESG? And what's been your experience as a leader on the ESG front?
Yeah, it's what an interesting topic, because I had a conversation last week with the chief legal officer, Morgan Stanley, which is one of my clients. And we were talking about ESG. And I said to him, and we've had this conversation over the last 2 years, and it's a completely transformed conversation now, because 2 years ago, when we started getting into it, his view was, of course, we need to, more, everybody focuses on the climate change aspect, the E part of this equation. That's where this conversation began. But I think when you really take a step back, what he's kind of embraced at his company, Morgan Stanley, is that this is a culture issue, right? It's a pillar issue for the banks as to how they run their business, right? So creating a sustainable business strategy is the beginning of everything that they talk about. Making sure that from a climate change perspective, both they and their clients, into whom they invest, are thinking about it and track it. I think a big one these days has been the social inequity. Obviously, that's been a gigantic conversation, which now I've got a conversation coming up next week with another top 4 global bank just about this and how they're implementing it in their strategy, and how they're changing their real estate footprint, how they're changing their recruiting practices, how it affects their global banking activity, how it affects their relationship with the community and their customers. Like, it's an enormous conversation. And then last, and I think definitely not least, is the G component of this, which is the corporate conduct aspect of the business. And he said to me last week, he said, we had to really up our game. Like, they've hired hundreds of people now just around the ESG front. And it's becoming one of the most talked about report outs for the board of directors at Morgan Stanley. So much so that they've taken one of their vice chairmen and put the vice chairman in charge of this initiative, right? So it's huge, I guess. It's very big. It has, it affects, if you think about these global banks, they have customers, they have an asset management where they have portfolios of assets. They need to instill their corporate philosophies upon their investments. And this is, and in the end, it's what their customers are asking for, right? People are asking for this, and they're asking for accountability. The accountability is the reporting aspect of this is enormous, and it's just getting bigger. So, I'll stop there, but it's a very big deal right now.
Absolutely, it is, of course, and I think it's getting a lot of momentum since Vivek is also here. Maybe Vivek, your perspective in relation to what's happening in the banks in India on the ESG front. Of course, the G is the most important element out here in terms of good governance. I'm aware that you're working on such things, but maybe how serious the banking in India is on the ESG front currently. What is the status, and how do you believe this would be achieved over the next couple of years, both on the ESG and even BRSR as well?
So interestingly, in terms of quite a lot of initiatives actually in terms of have started in that particular direction. So in terms of a couple of things, obviously in terms of from an ESG standpoint, there is a requirement of reporting because in terms of you would need to actually assess the level of exposures that you have, from a for lack of a better word, risks from an ESG perspective in terms of to measure in terms of what's your exposure. And once you get a sense of what's your exposure, then actually you could in terms of take steps in that particular direction. So I believe the reporting story is fairly addressed, from a country standpoint in terms of how entities are kind of reporting that and kind of putting the numbers out there. There is a lot more focus on sustainable finance from an RBI standpoint. In terms of they just came out with this whole, with this whole guidelines around this whole green deposits, which is essentially in terms of, raising deposits purely for the purpose of funding, funding aspects from a client resilient, initiative standpoint where funds could actually be used in that particular direction. These are at least in terms of, from a regulatory perspective, in terms of steps in the right direction. A lot of banks, though, in terms of and a lot of the smarter banks have really, in terms of, made a cut of their portfolios, made an assessment in terms of, what's the exposures they have, in terms of from a fossil fuel or an energy standpoint, and how exactly they would want to realign their portfolio. So there's a lot of thought process that's currently being applied in terms of how would the portfolio get reconstituted, and those kind of portfolio analysis is something that a lot of banks are actually in terms of doing it, and not just for the purpose of presenting or showcasing that, oh, look, there are these initiatives that we are doing, but more so from a perspective that there's a very conscious change that they actually believe that they want to drive. Because if the entire credit direction is kind of driven from a whole ESG mindset standpoint, you have the investment community that is kind of focusing from that standpoint. You have this whole ESG focused asset management schemes that the SEBI is kind of bringing in. You have, from a banking standpoint, sustainable finance, from a deposit standpoint that's coming in. You have renewable energy, and you have certain sectors being classified as priority sectors so that credits can actually get channelized. So I think in terms of the basic hygiene in terms of ensuring an ecosystem where things can actually grow, that's been put in place, and at least things are moving in a positive direction. I wouldn't want to get too excited about it because we yet have to experience the whole greenwashing thing that we have to go through, because we will experience that. So that's a piece of journey in terms of that we will experience and we'll come out wiser. But at least things are moving in the right direction.
So, if So, if I were to look at the same situation, of course, it was interesting hearing Matt's perspective on some of the large clients in the US. But what has certainly happened is the awareness of this, the entire concept of ESG, because now corporates are being rated on ESG, right? And you therefore know your rating. And that rating then translates into potential investments one might get from the investment community, particularly the global investment community. I'm not so sure the Indian investment community is so far that bothered about this, but the global money is going towards, is getting directed based on ESG. So some of this is therefore driving at least some of the form aspects, right? And the reporting aspects and how much one reports in annual reports and the kind of cuts you can take and what you can talk about and all of that, right? I would say what we need to really see is how much behavior changes in India in terms of when it actually comes to, say, lending. It might still happen on the investment side. So if a portfolio manager gets money which can be invested sustainably, that portfolio manager will then invest it appropriately. But if a bank has funds, and a bank would be happy to get green deposits, the bank anyway has assets which are renewable and so on and so forth. So therefore, it can be deployed there. Therefore, if another source of liability is always welcome. But when it comes to lending, I think we really need to see behavior changing. I haven't seen that too much. I think there is work happening, quantification of climate risks and so on and so forth. And of course, looking at governance and building that into lending and other models is happening. But I would say for that to really happen sustainably, the regulator has to sort of start playing a bigger role in terms of modifying behavior, you see. Otherwise, what will happen is the bank which follows this could end up believing it's going to lose out, right? So, therefore, it really requires a lot of philanthropic, vision for mindset for banks to sort of go down that path. So it's a area which is definitely picking up, but where it goes to really needs to be seen. And I think it really requires a combination of two things. One is therefore the investors on one side putting pressure and the regulator on the other side nudging in the right direction.
Yeah. That's right. And it should be in the right balance. Yeah.
One other quick comment, and that is, it's interesting to note that when we look at Credit Suisse, it's the governance risk that really brought the house down there, right? And so that's something that I think in the past, the governance risk might have been swept under the rug or potentially managed in a different way. But this one was, absolutely not. I mean, that was, this is not an okay environment. It's not a sustainable environment, right? And therefore, it needs to be consumed by UBS in this case. So it's just maybe the environment, maybe the ESG environment that's been created that in and of itself.
Yeah, but I would believe that the G part of it, the governance probably, if one were lending, I think the governance is the easier one to sort of, it sort of fits in well. The tougher one is, let's assume it's the environment side, right? How much do you lend to sectors which are polluting, or environmentally negative? How do you lend more to entities which are environmentally positive? These kind of things become a little harder. Governance and credit risk actually go in the same direction. And so that is really the part which would be interesting to see how it plays out in India, at least.
Absolutely. And I think you made the right point that, to what extent the regulators also would help creating more awareness.
Correct. That is
and
correct.
I would even say that, those charged with governance are individuals who want to do the right thing. But many a times what happens is, given their other commitments, it's important for the management and for the board to create more awareness for those charged with governance, to give them that particular training, to give them that perspective so that they would be in a better position with their experience to bring that optimal combination of financing in such a way that it helps the entire endeavor and the agenda of the ESG. So very, very well summarized by all of you. Thank you so much. Paul, my next question is, of course, to you. I mean, and we all know that RBI, the Indian banking regulator, well, very, very clearly it stands out as someone being very conscious about the health of the bank. We know the kind of rigor in the inspections, the strictness in the concurrent audits that the concurrent auditors do, the kind of questioning to the internal auditors, statutory auditors on everything. And of course, the respect and the significance that it has on the risk management framework. It's ring-fenced the entire industry in a way where the banks are insulated to a great extent from such crisis that happens globally. Maybe still there are 2 or 3 things that we need to do in India, and maybe the regulator could be thinking about it. I'm sure there could be some discussions happening in the boardrooms, or there could be some suggestions coming from the industry as well, to sort of, further ring fence and enable better business opportunities for the banks? What could be those one or two important things, according to you, should be the priorities for the Reserve Bank of India to roll out such initiatives?
Yeah. If you look at the entire space of lending in India, it includes the banks. It includes, the scheduled commercial bank. Then you have the other banks, the small finance banks and the cooperative banks and so on. And then the very large segment of non-banking finance companies, right? The regulations which apply to banks, at least the scheduled commercial banks, are reasonably uniform. And the larger ones are definitely subject to very tight scrutiny. The smaller ones, probably less so, but still they are subject to the inspections, and it's just the extent which may vary, but the boundaries are all the same. I think the equivalent of an SVB would be not the SVB, I wouldn't say the SVB kind of situation, or the smaller banks in the US would be the non-banking finance side, where if the regulations are not sort of reasonably uniform between banks and non-banks, it doesn't have to be exactly the same. That can pose risks for the entire system, right? Because banks have fairly large exposures to non-banks, and those kind of exposure risks can arise. As Vivek had mentioned, the RBI has definitely started tightening up there, but that's a process which needs to sort of go further. I would say from the, we had the entire, the last crisis we had was before the current COVID one, was really the credit related, the lending related issues which many of the banks had, where they were sitting on large non-performing portfolios and so on. And the entire insolvency and bankruptcy code, etc., which came up, that entire process of bankruptcy and NCLT and all of that, that has really helped to a certain extent. However, I think if we have to actually insulate the banks further, quick resolution is really going to be critical. And I think there is further work required in this broad area. So if I were to, I give the RBI and Indian regulators a lot of very high marks. Of course, it's in a slightly simpler environment as opposed to, say, the US, where, it's a global environment. You can pretty much do anything there. In terms of putting all the boundaries and the guardrails which they have put in place to ensure that banks can't go too wrong. I think what the US and even the Swiss regulators have shown is the speed with which you can react or act when something does go wrong, right? And that is something which I think we must learn here as well, that if something seriously goes wrong, in a couple of days, a bank like Credit Suisse, if it can just be absorbed, that is a learning for all of us.
Oh, yes, of course.
That's amazing. Yeah.
Matt, in terms of what could be your asks to the global regulators or the regulators in the United States, in terms of top 2 or 3 things that need to be implemented or brought into the system immediately, having seen this kind of crisis?
And this is something, well, first of all, I think that the banks are not all equal, right? They're not all the same. The larger banks have different needs than the smaller banks. But I think what we saw during this last crisis, some people would say that the regulators were late to the game, that they didn't see this. I actually not sure that that's true, although there's some criticism there. I think that they're working within an environment that's been around for many, many years, and this just got very exacerbated at the SVB. But what I would say is, it's funny because I'm reading the book right now. It's called The House of Morgan, right? And back in the day, before central banks existed, the banks were the regulators, right? The banks were the regulators of business. They supported the issuances that they put out there, the lending they put out there. What I saw during this last crisis, which I think needs to be more institutionalized, is the cooperation between larger banks working with smaller banks, rather than to hit the trigger, the execution button on takeovers. I think that there can be a longer period of resolution where the larger banks work to support the smaller banks. Because I think the larger banks know and want the smaller banks or the regional banks to exist. It's part of the ecosystem of the banking environments, right? I'd personally like to see something that's a little bit, a conversation that institutionalizes or codifies the process they go through, where they're working with the larger banks to help support. I mean, this happens in many of the cases, and it always seems to happen, but there's never been like a direct conversation of this is exactly what we're going to do in these events. So that's something that I think would be interesting for them to think about.
No, that's great. Thank you. Thank you for that. I think we have limited time now. So maybe the last question, and this question will be to all of you. You could respond in your individual capacity. How do you believe is the future going to be of the global banking and the Indian banking? Are we going to be there? Are we heading for exciting times? Are we going to be heading for difficult times? Are we heading for different kind of times where the concentration, and especially this is happening in India, Matt, where there is a lot of focus on retail lending. There is a lot of focus on retail rather than corporate and institutional, and of course, going the green financing way. So let me begin with you, Matt. How do you see the times exciting in the United States and the rest of the world?
Well, I think it's so much of what happens is driven by events, right? So putting that aside, like a little thing called COVID, I think that what I see is a greater cooperation across borders, right? I think understanding and dissecting the large bank, medium bank, small bank, and their needs, I think needs to occur, right? Because we're seeing it's not an equal environment. These are not two, but they're all equally important in the ecosystem of banking. And so I think a conversation needs to take place as to how these banks are regulated, sharing of information between the two, support mechanisms, like I mentioned just now, between larger banks, smaller banks, regions, and more open conversations with regulators as to what is acceptable, right? So I think that's the most important thing that we can get out of this is to open up the dialogue around what has happened, what can happen, and how do we support the ecosystem of banking, right? So across the entire.
Thanks for the perspective. I completely agree with you. Yeah, Paul, your perspective.
Yeah. So the genesis of some of the crisis we've seen in the US recently is really because of interest rates going up, and of course a lot of the consequent issues there. The question in my mind is, and it's not just the US interest rates that have gone up. Interest rates have gone up in various parts of the world.
Right.
And while in India, it may have gone up from 4% to 6.5%, but in many of the other parts of the world, it's gone up from 0% to 5% and so on and so forth, right? So the key question really is, is there any further lurking danger out there because of interest rates rising? So that's what bothers one sitting here, right? And therefore the risks to us sitting here, and of course the entire global banking system around it, because it's, as Matt rightly said, it's events which happen, and each event is it's not that the system at large foresaw it. Most were taken by surprise, right? So is there any other surprise out there because of events which are happening? Interest rates going up like this is after such a long time, right? So we really need to see if there is anything out there, and that's something which we need to sort of watch. I think from the Indian banking system, we are seeing a credit cycle right now, which is probably, we haven't seen such a benign credit cycle for a long time, right? So from here, it can only get worse. It can't get better. And therefore, one has to be extremely watchful. India is now, at least in terms of liquidity, tied in tightly to the rest of the world. So in the US, at least the interest rates seem to be topping out, but we need to see what happens. I mean, you had the UK, the interest rates in the UK, the inflation touching 10%, right? And that's the latest there. And therefore, interest rates going up there. Europe, it could again go up. So what happens to overall liquidity and how that impacts us here is really going to be a key question, which needs to be looked at, because so those are all the dynamics at play. So it's an interesting time again, but we are hopeful it should end well.
And hopefully keeping fingers crossed that, no more natural disasters or any kind of untoward incidences happen, like what happened earlier, which can really create a more, a larger problem.
Hope and yes, that's right. Yeah.
Vivek, maybe a 1 minute perspective from your side in terms of how do you see the future in India?
So at least in terms of one of the things that is going to be at least it's a personal sense is that, in terms of interest rates are going to be elevated for some time. And probably what we saw in the, in the previous decade of low interest rates that won't stay anymore. So with the neutral rate of interest kind of moving up in terms of the world, we'll have to kind of get adjusted to that level and kind of deal with it. The geopolitical risks are going to increase significantly because they're not gone away, and not just about the Ukraine crisis, but the whole Sino-American relationship and the whole Taiwan issue that's there. That is going to result in situations where there are going to be uncertainties in terms of from a global standpoint. As India gets more and more integrated with the global ecosystem, we cannot be insulated away from these challenges. So those are uncertainties, those are aspects that we'll have to deal with. So more so in terms of the role of the regulators, the role of risk management as a function within banks, these are going to be assumed significant importance. These are for sure. In terms of these are changes that are going to happen in terms of from a significant standpoint. From a banking revenue opportunity standpoint, we believe there will be a lot more opportunities, primarily out of certain imperfections stemming out of the global system, because there will not be globalization, there will be larger regionalization, there will be inefficiencies. And to that extent, because there is duplication, there is going to be so much need for funding across different places. So I believe that will result into potentially inefficiencies, but some, from a real economy standpoint, but from a financial services, I believe it could potentially kind of result into some form of gains. That's in terms of, as I said, maybe I'm kind of, I've gone inside the crystal ball probably, but in terms of, those are some thoughts.
No, absolutely. I completely agree with you, Vivek, as well. So because we have a little bit of constraint on time, maybe let me just completely switch gears and maybe we go to the questions. The first question is from CEO Vishesh Chandiok, and I think maybe any one of you can respond. I would suggest that Matt, you would be the most appropriate because it means globally as well. The question that Vishesh has is that how bad can this crisis get, or do you believe it's contained and over? I'm sure you did share some perspective, but specifically on this question.
Vishesh always has a way of getting right to the point, right? That's good. Listen, I don't think the crisis is over, but I don't think that it's going to become rampant, right? And then I think what we've seen is it's been fairly contained. I think the regulators are absolutely out there on search now. They're on the lookout for what I might call black swans, like things. Certain banks that pose certain idiosyncratic risks that within their portfolio. I think that there's a lot of ALM discussions going on every day right now since this crisis started at banks across the world. But I don't think that this is going to, and I think most analysts that I talk to, most regulators I talk to, don't think that this is going to be a rampant, knock-on event that's going to occur. I think it's been a healthy process. If anything, I think you can look at it very positively and say this came about. Let's look at these unique risks and let's apply them to our bank, and how can we take a look at through those lenses. So
you're right, absolutely. Every crisis leads to learning and the correction. So it's definitely something that would be mitigated going forward. But maybe Paul and Vivek, any specific views that you have on this question, besides what Matt mentioned? You would want me to repeat the question, or?
No, I've got the question. So it's hard to say. So, many of these, as I was saying earlier, many of these situations arise because of events, and rarely does one see those events in advance. So if things go without events, then I would hope that this doesn't become rampant, right? But with interest rates having gone up so much and the knock-on effects on the real economy in various places, and some of the slightly less than tight oversight and differential regulation of different pockets of the financial system, what risks are out there is unknown. So the best case is, yes, it's not going to be rampant, and we'll sort of get out of this fine. But as a risk person, I would sort of be constantly worrying and looking to see where is the next event going to come from and what is out there, right? So that's how I would sort of look at it. That doesn't answer the question, but it's
Anything can happen at any point of time.
Anything can happen. I would say probabilities are low of something major happening, though. Yeah.
With a better framework and more emphasis on risk
correct.
management.
Yeah.
Absolutely. Let me go to the next question, and I think this is the last question. The question is coming from Sahil Sethi. The question is, how can hedging the interest rate risk in the given scenario save this entire issue? So the question is, would hedging really help in mitigating these kind of things?
So if I may.
Yeah, please, of course.
Yeah. So one of the things is, so one thing that we need to understand about hedging is minimization of losses. Usually the expectation is that hedging is going to really, in terms of save us and get us into a different zone. No, it helps us minimize the position because there is a direction in which the market's moving. And to protect yourself against that, when you actually take a hedged position, it helps you mitigate the extent of damage. So hedging from that extent can definitely, in terms of help you mitigate the damage. But, we be clear on that, understanding that it is not a magic pill that is going to take away all your problems. So far as that, I mean, at least from that perspective, I believe a hedging can help.
But, therefore, if Sahil is referring to the SVB kind of a situation, then I think the way to address the risk is really positioning oneself such that one is not affected or impacted by that risk, or the impact, if any, in a stress situation is a manageable impact, right? Rather than hedging, have a bad position and then hedge it. So if your duration of the liabilities is short term, then the asset duration has to be short term. And otherwise you're or the mismatch has to be to an extent where extreme stress situations still do not put you into a situation where you have to shut down. So that's how I would sort of see that situation.
Surely, thank you. While we were just trying to wrap it up, there are some couple of questions coming up. So I hope, gentlemen, it's okay if I can just take 5 more minutes. I know we have crossed 1 hour, but I hope it's fine.
Yeah.
Thank you. So we have a question from Sumit Talwar. The question is, could the failure of Silicon Valley Bank and Signature Bank be the start of a domino effect of falling financial system and the beginning of a new financial crisis? I think we have covered this, but maybe I think, Matt, you would be best placed to shed some information on this.
Well, I think, I think generally speaking, I don't think it's, given the circumstances today, they could change, but I don't think it's the beginning of a larger US or global banking crisis. But I think it was also, there was a question too that said, is this also going to put the Fed into a position where they need to rethink continuing to raise interest rates? And I think the short answer is absolutely, because, again, everybody learns from these situations. And I think that this is causing the Fed to, ponder the schedule for rising interest rates and whether it's really the use of the rising interest rates to combat inflation. So it's a balancing act. I mean, and I think that this is going to cause them some consideration to think through what their strategy is going forward. And it may just be about the trajectory of inflation, or adjusting their view on the trajectory of inflation. But I think it's important that they're doing that, and they've acknowledged that.
Thanks. There's one question from Ravi Bhardwaj. Ravi, I think we have covered this substantially, but maybe I think I can request Matt to share something that is not being covered as yet. The question is the US banking crisis going to stop interest rate rise by the Fed? Whether the crisis is totally visible or something is more cooking inside? We did answer, I mean, we did cover this, but maybe Matt, specifically on the interest rate rise by the Fed.
Yeah, and I think to my point I just made, it's really, I think that they are considering it. It's part of the equation now. It wasn't part of an equation before, but it's definitely part of the conversation now, whether or not to raise rates. And I think that's a good thing. I mean, they need again these factors. They have new factors that they're building into their considerations, and that's a positive thing as we calibrate, the process going forward from an interest rate rise. So I think we're going to continue to see some, smaller rate adjustments, but I don't think most analysts I talk to don't believe it's going to go beyond that, 2 or 3 more, potentially smaller. And then we'll see a trajectory, hopefully at some point in the near future, of decreasing rates, right? Yep. Where that apex is, I don't know. Maybe Paul, you could tell me. I'm sure you know, right? So
the only question the situation since the last aggressive set of rate hikes, which were about 40 years ago, and today is that the debt levels, in the economy and of the government are so high, right? The impact of rate hikes, the question is, where will all that lead to? Today, of course, the dollar is the reserve currency, and therefore, you can you're sort of in an okay position. But all this borrowing, the impact on the overall fisc of the US itself can be and of many of the other developed countries can be seriously impacted by interest rate rises now, given the fact that the overall debt is so much. Yeah. So that is the thing one worries about. So I agree with you. I don't think it'll be too much more from here, but these are things which bother me right now.
There are some more questions coming, so maybe I think I'll just cover one more. And this is a little pondering kind of a question. Maybe Matt, you could be best placed again. The question is from Kiran Bindu. Do we see more SVB kind of failures if the interest rates keep increasing? You need to be a magician to answer this question.
Yeah, it's a tough one. I think it's going to, I think we might, I think is the answer. We think we might see selectively some more SVB-like situations, but I think more likely what we're going to see is a better advanced identification of potential banks like SVB and interventions from the regulators in conjunction with the larger banks to support. So I just think that they've gotten better at tapping into the global, the bigger, larger banker liquidity environment to at least buy time to fix some of the issues of banks that are similar to SVB. So the short answer is maybe, but I think more likely we'll see a better coordination of the regulators with the larger banks.
And SVB kind of a situation to a certain extent. Now the Fed has opened up the window where banks can borrow against their securities from the Fed without doing a mark to market, right? So of course, Matt, you'll know it better, but probably that protects banks against, provides them some amount of liquidity as long as they have securities which are acceptable. The only question that throws up is what kind of worms does this lead to, right? Because if the value of those securities is so much lower, what is the whole is like, the Fed is actually lending without collateral. And that opens up a different kind of so that's a probable problem for the future. And but for the short term, therefore, it might help prevent or reduce the probability of the SVB kind of situation.
That's right.
Yeah, mark to market is a difficult conversation because
Yeah.
mark to market means loss, which means erosion of capital,
True.
which means a lot of things that are bad, right? When theoretically you have securities or loans that are inherently good credit risks, right? Albeit longer tails, which make it difficult. So tough one. It is an interesting conversation.
True. We'll just take this last question. And that's from Aditya Pawar. The question is that, is there a need of another regulatory body exclusively for such economic crisis or risk management to counter such problems more efficiently? Yes, we're talking about different parts of the globe. So Matt, do you believe in an economy like the United States, this is possible?
I think the existing system works insofar as if we're able to, if the crisis looks like they've looked historically, which we can guarantee the next crisis won't look like this, but if they look like they've looked here, I think the existing the existing regulatory structures and players fit the bill. If we start to see something that's more of a pandemic contagion credit loss event globally, like we did back in the Asian flu times, of the credit risk, the real estate risks starting in Asia and then moving across the globe, that was a situation where we really needed to make sure we were well connected. And maybe under those circumstances, there needs to be some kind of global banking authority that can help coordinate the response, right? So,
Paul, your thoughts in terms of the Indian banking system?
As a banker who's suffering from over-regulation, I wouldn't want another regulatory body here. I think what is required is the regulator to regulate properly. So if you're in a global situation, a body which sort of helps coordination across the world is fine. But otherwise, adding one more regulator will not need not necessarily improve the handling of a crisis. I think what you require is the regulator to have effective regulations to control to prevent such a crisis, right?
True.
And so that's how I would sort of believe that's the way I sort of see it. I wouldn't add another regulatory body.
I completely agree. That could create more chaos and more.
That's correct.
Differences
Yeah.
between the two. Yeah.
Yeah.
That's it. So let me take the opportunity of thanking all of you, Matt, Paul, and Vivek, for being here. Matt, for you especially, I can understand you are in a different geography. It's very early in the morning, and we did catch up even before this. So once again, thanks a lot.
no problem.
For your participation. Paul, thank you so much. I'm aware that you had some important things to be done this evening, but nice of you to make it for this particular webinar. Really appreciate that. And
No
Vivek,
problem.
as always, you smile and you're always available, so truly appreciate that. Thank you once again. I also thank everybody who have participated in this webinar, and feel free to let us know in case if at all you believe certain questions may not have been answered appropriately. You can write to Vivek Iyer. And I believe somebody mentioned about Black Swan, and I'm aware that the firm had rolled out a publication on Black Swan. So maybe Vivek, would you want to mention something on that?
Yeah, in terms of, it's just a short synopsis in terms of what was the event about and what could be some of the things done in the future. It's a quick way of, it's like a cheat sheet, if I might say, in terms of just what this is about. So we kind of just put that in, and I'll just request one of our colleagues around to actually in terms of paste a link that where you could actually in terms of go there and kind of get a quick sense of things. And in case of any questions, always feel free to reach out. We're always there.
So Ram is posting a link on the chat box, right, Vivek?
Yes.
Okay, that's great. Yeah. So thank you, gentlemen, and thanks to all of you for being there this morning, this evening, and look forward to our interactions once again in the future. Really appreciate your time and your perspectives. Thank you.
Thank you.
Thank you.